At some point over the last few years, investing stopped feeling like analysis and started feeling like watching a game of Wheel of Fortune. And honestly, it's been pretty entertaining because it's hard not to smile when someone on Reddit turns a weekly options trade into a 2,000% gain and then immediately posts a screenshot like they've just unlocked the capitalism speedrun. But while it may be awesome to watch from the sidelines, it's also deeply unsettling. Because for most of modern financial history, markets weren't perfect, but they were at least anchored to something real. Things like earnings, cash flows, and economic data. The boring adult stuff. And sure, historically, markets have always had periods where they go through manic phases. But whether it was large-cap stocks in the 70s, internet stocks in the early 2000s, or even the banks in 2008, eventually fundamentals showed up like gravity, because you could ignore them for a while, mock them, and even post memes about them. But sooner or later, intrinsic valuations mattered again. Because there was always an unspoken belief that value investing was at the foundation of markets. But over the last few years, it feels like that belief is changing. And it's not because prices are high, markets have been expensive before. And it's not because speculation is present either. Speculation is basically a market tradition. What feels different this time around is that the relationship between market prices and fundamentals feels loose. It's like they're technically in the same room, but they just aren't on speaking terms anymore. Because since 2020, if someone tries to bring fundamentals back into the conversation, they get the same reaction as someone asking the DJ to play Nickelback. Because the pandemic wasn't just a shock to the markets, it rewired them. The story used to be invest for the long term and buy quality companies at fair prices. But since the pandemic, the story has changed. Now it's buy the dip because stocks only go up. And that phrase alone should make you a little uncomfortable. And not because it hasn't been working, but because it has been. And what used to be a strategy has quietly just turned into an assumption. And this mindset shift didn't come out of nowhere. It was the perfect storm of a mass influx of new investors, interest rates being historically low, and Jerome Powell's money printer doing its best impression of a fire hose. And slowly but surely, the markets adopted a new mindset, where every dip is a gift and every sell-off is a buying opportunity. And here's the part nobody likes to talk about. This didn't just affect retail investors, it's affected professionals. Because when markets stop behaving the way you were trained to understand them, experience stops being an advantage and starts becoming a liability. Take Michael Burry, for example, the same Michael Burry who famously profited $800 million from his bet against the housing market in 2008, and the inspiration for the movie The Big Short. He's the human embodiment of trust the fundamentals and ignore the noise. And recently, he shut down his hedge fund. Why? Well, in his own words, he said, "My estimation of value in securities is not now and has not been for some time in sync with the markets." Which really is just him saying the market has stopped pricing assets based on fundamentals. And you can see it across the board, from gold to real estate to equities to crypto. And if the market can stay irrational longer than you can stay solvent, then value investing stops being a viable strategy in markets. So if someone who built their entire fortune on trusting fundamentals is wondering whether gravity still applies to markets, it forces a deeper question. If fundamentals aren't driving prices anymore, then what is? And this is where behavioral finance enters the story. Because while traditional finance assumes markets are efficient and rational, behavioral finance starts from a very different assumption. It assumes markets are human. It assumes that things like human psychology, emotions, and psychological biases drive market behaviors. Which may sound obvious, but for most of modern financial history, this was an unpopular concept. Because psychologists Daniel Kahneman and Amos Tversky pioneered this field back in the late 1970s. They showed that humans don't evaluate risk objectively, that we fear losses more than we value gains, that we anchor to narratives, and that we instinctively follow crowds. But despite the evidence backing these ideas, behavioral finance still spent decades living on the fringes of investing. Traditional investors just treated it as a way to explain anomalies in the markets, things like why bubbles formed and why panic happens. Investors assumed markets were efficient and just sometimes had the occasional emotional hiccup. But after 2020, something changed. The question shifted from what is this company's intrinsic value to how will people react to this news? Because when narratives matter more than balance sheets, momentum overpowers valuations, and prices move without fundamentals catching up, there is something deeper going on, and investors were forced to adapt. Because behavioral finance stopped being used to just explain edge cases and started being used as the operating system everything else runs on. But before I jump into how social media has quietly poured fuel on this fire, there's something else I need to tell you about, which brings us to the sponsor of today's video, Aura. Because here's something that should make you uncomfortable. Right now, there are data brokers making billions of dollars by selling personal information online. They create detailed reports that include your name, your contact information, your address, and even who your relatives are. If they can collect it, they can sell it. And the scariest part, they don't really care who buys it. Scammers, spammers, or stalkers. If someone's willing to pay, your personal data is just another product on the shelf. And that's where Aura comes in. Aura helps protect your privacy by identifying data brokers that are selling your personal information, and then automatically removing your info from those sites and keeping it off. And Aura is built to cover the full range of modern digital safety. With Aura, you get alerts if your personal info shows up on the dark web, real-time fraud alerts for your credit and bank accounts, a secure VPN, and access to 24/7 US-based fraud support experts who are ready to help if something goes wrong. And if it does, Aura includes up to $5 million in identity theft insurance protection. Because human behaviors like greed, fear, herd mentality, and recency bias have always affected markets, but they used to be constrained. Information moved slowly, participation in markets was limited, and trading had friction. But now you can wake up, see a hot stock tip online from some guy on Twitter, and then deploy capital before you've even finished brushing your teeth. Because narratives don't spread over months anymore, they spread over hours. And that's how markets have changed. Behavioral finance used to be a supplementary force in pricing, and now it's at the forefront. Because social media and the internet has collapsed the distance between information and reaction. So when enough people agree on the same story, prices move, and often with little to no regard for fundamentals. And here's the part nobody likes to talk about. This didn't just affect retail investors, it's affected professionals. Because when markets stop behaving the way you were trained to understand them, experience stops being an advantage and starts becoming a liability. Take Michael Burry, for example, the same Michael Burry who famously profited $800 million from his bet against the housing market in 2008, and the inspiration for the movie The Big Short.